Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Welcome to another episode of Swimming with Allocators. Today we have Aram Verdiyan. He's a partner at Accolade Partners, one of the top performing alternative asset platforms in venture capital, growth equity, and blockchain. He's had previous experience at Andreessen Horowitz and had some consulting experience. Today he's going to share with us the principles that drive Accolade's investment strategy across venture, what separates consistently great managers from the pack, and the role of LP conviction and engagement in building durable GP relationships. So with that, we welcome you to the Swim with Allocators.
Thank you for having me on. This is great.
So glad to have you on. We had a great prep conversation a couple weeks ago. But one piece of that was I thought was really fascinating was just hearing your background and how you got into this role. So if you could just share some highlights from just how you got to Accolade.
Yeah, happy to. I graduated from college right around the 2008-2009 financial crisis. It was very hard to find a finance job, and I got into consulting. I always had wanted to explore private equity. I knew loosely what venture capital was, but didn't have a great idea. And so I was in Washington, D.C. working consulting, saw an analyst job opening at Accolade. I didn't know what a fund of funds was. I mean, I literally knew nothing about allocating. I didn't know what a capital call was. So I applied, and after applying online, I didn't hear back, not surprisingly, because my background was nothing they were looking for. And then I called them, and I said, you know, I'm local. At the very least, I can just come in, have a coffee with you and learn about your business. They thought it was weird, but they said yes to that request. And so I came in, and then 5 rounds of interviews later, I got the job. And that was 14 years ago. In between, I did go to business school and then came back and did a few things in business school that were, I think, very accretive to the job I do today at Accolade. So I worked on the direct investment side. We had some operating experience as well, starting a company, and then came back. So. But yeah, I would have never expected 14 years later I would still be here. And when I joined, I mean, it's interesting because I sometimes talk to either undergraduate or graduate students who are thinking about charting their career path, and they're saying, I'm at A and I want to go to point B in the next 5 to 10 years. And the two things I've always told them, at least from my experiences, that point B may not be what you think it is 10 years from now. And secondly, if you are going to go from point A to point B, it's most likely not going to be a linear path. So just have that ambiguity in your mind as you're thinking about what's next in your career. 14 years later, my team and I still send cold emails all the time. It hasn't changed. I mean, we were cold emailing for fundraising back then. We'd have to do less of that now just because we have a very established track record. But back then, we cold emailed managers, we cold emailed LPs, and to this day we still do it.
What would you be pitching? What's the Accolade sort of story?
I think any LP that wants to use a fund of funds, this is not an Accolade, this is a fund of funds pitch, and then I can narrow down to Accolade, should get 3 things. One is access, and access that they can't get themselves. I mean, that's fairly standard. Every fund of funds that exists in the world is going to pitch access. That's why they exist. Secondly is returns. And what I mean by returns, and I'll specifically focus on venture, and blockchain can be a part of this, I know we'll discuss it later, is venture has, as you know, this dispersion of returns phenomena going back to 50 plus years, where the top 10, 20, now it's more than 10, 20, but the top 10, 20 companies per year drive the majority of the returns in the industry. And only a handful of firms are getting access to those companies at the early stages with lead checks. And so when you think about that, there's 0.1% of all the firms really drive the majority of the returns. Same on the company level. I mean, how many 50 billion plus market cap companies are there today that are venture backed? You can count them on 2 hands. And so if you are a fund of funds and you're pitching you have access, then theoretically you have access to that 0.1% of the firms, which means you should be able to outperform even the direct top quartile benchmark. The top 75%. If you're truly getting access to the 0.1%, even with an extra layer of fee and care, you should still do better than the top quartile direct. If you don't, that means you're actually not getting access to that 0.1%. And so anyone who's using a fund of funds should not only benchmark those fund of funds to other fund of funds, but to actual direct funds because of the dispersion of returns in venture that exists. 3 is the reason you're using a fund of funds is because you don't have a dedicated team that can do it themselves, and you want a portfolio of whatever asset class you're looking for: blockchain, venture, seed, Series A, early stage, late stage. And so 1 is access, 2 is returns, but the returns I want to be very specific.
Okay, if we're now saying, okay, we want to be in fund of funds, now why Accolade?
Well, 1 is we have the access. 2 is we've consistently beaten the top quartile direct venture benchmark. And the third part I would say is we take a concentrated portfolio approach. So what is concentrated? And I want to go back to the first thing I said. There are only a handful of firms that do well every year. And we can quantify that too. Our data is not perfect, but it's pretty accurate. So if you look at the last 20 years, if your N is 3,000 to 4,000 venture firms in the US, there are maybe a couple dozen that consistently have generated 3x net. So that percentage, the top end to the bottom end of the funnel, is really small. And so if someone came to you and said, I'm running a fund of funds and I'm going to have 50 venture managers over a year or 2 years, it's just really hard to find that 0.1% over so many managers in a 2 or 3 year time frame. What ends up happening is you might end up with like an index-like fund of funds. If you're doing the index in venture, just do the public markets. You can get tech exposure that way. Do private equity, better liquidity, better risk return profile. And so the way we think about concentration is 2 ways. 1 is we want every manager to be meaningful to our portfolio. So when they get a 5 to 10x fund level outcome, you have a shot of returning half of our fund of funds or more.
Awesome.
Second thing I want to say about that is that let's look at the actual company exposure. So what we have found over the past 20 years is if you look at our top 10 companies on a look-through basis, we have about 300 to 400 companies in every one of our fund of funds, but the top 10 companies are able to return more than 1x our whole fund of funds. So you can say 2 things there. Well, you were great at picking, good for you, but you actually sized the manager correctly in your portfolio. What would be really frustrating is that if you pick the right manager, they had a 10x return at a fund level, and it's like returning 10% of your fund. Like, you're not going to get another 10x funds in a single fund of funds. Statistically, that's hard to do. And so we think a lot about what's the optimal level of concentration where a single company or single manager can really drive returns for us.
Wow.
That means you have to pick well, though. Like, there's the con of that is like, well, if can't have a 0, like that will really hurt your performance. But you have to pick well. But if you don't pick well, then but if you're going to have the diversified approach, I don't know if you need to do venture that way. Like, you're going to get the average return. The average return, you can look at the Cambridge benchmarks, it's not great.
No. There are other asset classes that have far better risk return profiles. Wow, that's an interesting and I think a very impressive way to look at fund of funds and what you should be benchmarking against.
Can I tell you another way you can look at venture broadly? So right now, every year, run rate 75 to 100 billion is raised by venture capital firms. That's the fundraising number. That's per year. To 3x that as an industry, you need to generate about 600 billion or so in exit value. If you assume like VCs are going to own about 40% of a company or so, or 50% at exit, you need to generate 600 billion in exit value per year. We don't necessarily have that. Which is why it goes back to the same dispersion of returns. Like, you will have a Stripe, an Enduro, a Figma, a Databricks. These are amazing companies. But that's not well distributed across the whole industry. It's going to a handful of firms.
Yeah.
And you're such a quantitative person. Are you thinking of picking in a quantitative way, or is this a qualitative, is there a balance there? If you're not indexing, I'd say those are like the full quant index fund of funds. What's going into your picking process?
Yeah, you can't be too quantitative here. It has to be a combination of the two. Because a lot of the times what we do is a fund 1. We actually love starting with the manager at fund 1, being their biggest LP, growing with them over time. And so at fund 1, I would argue you have the least data. Now, it doesn't mean you have zero track record. There are indications of your track record from your prior body of work, but we're not one of those LPs like, we need to see fund 1 and 2 and 3 and then some DPI in order to do the next fund. Like, that's just not who we are. We need to be able to see a body of work that's represented enough, and we ourselves would do a lot of projections to get a sense of, does that body of work map to what the manager wants to do at fund 1? And if the answer is yes, that's the perfect entry point for us, typically. That's where we lean in. We're the biggest LP. We grow with them over time. The other thing we do that I think could maybe be somewhat contrarian is a lot of LPs over time scale their checks to a manager because they say, oh, it's fund 1 is too early. Let me write a $5 million check. When they're on fund 4 and it's like much bigger, we'll write 4x that check. We increase our allocations to managers over time, but we start at a core large check at the first bite. And usually the first few funds are the best ones.
How do you think about right sizing in terms of that check size to the fund size? Can you share some
So
of
it
that?
depends. So like if we have a $500 million fund, 25 to 30 is sort of the minimum we like per manager. And we don't care about being a large part of a manager's fund. So if we've done 15 on a $20 million fund. I mean, I tell you, like, our managers we have in our portfolio, if today they told us you can have the whole fund, like, we would have a serious conversation about doing that. We don't care about the concentration risk. Like, we don't need to see others come in for us to anchor our fund. We want to be the first ones to do so. I also think the GPs we back are very aligned with that as well. Like, I've had this conversation with managers quite a lot of saying, don't optimize for a fund based on a LP's check. What do I mean by that? And if an LP comes to a manager and says, well, I can only write a $20 million check, but I can't be more than 20% of your fund, that means you have to have a $100 million fund.
Yeah.
But say your fund math bottoms up to get a 5x plus works at a $50 million fund. What are you going to do? Most folks end up raising 100 million. The GPs we back will say no to that capital and raise 50 million. And then we'll go to them and say, we're happy to take the full 50 or give us 25 to 30 at least.
Wow. I love the intention and conviction that you have with GPs. Can you speak to, you all have been doing this over a number of years. How do you think about reevaluating funds as they, become more and more mature?
It's pretty constant. Like, we are constantly in touch with our managers and all their team members. We are not the type of LP where the next fundraise is coming, the data room is open, and that's when we start like diligencing the existing funds. Like, by the time the data room comes, we've already made our decision. And so we are constantly in touch with the managers, their portfolio companies. I would like to believe, and I'll take a step back, we don't do international venture. We don't have other products. We just do venture blockchain growth, like US primarily. That's what we've been doing for 25 years. We have a small team. We've had no turnover on our team, so it's the same people underwriting the managers for a long time. And so what we would like to believe that if you called any of our managers and said, who is your highest value add, highest engaged LP, who knows the portfolio well, who has had a consistent track record and program in venture, and who really understands your portfolio, we're going to be on that list consistently. And so when they come back to market, we will do our formal process of writing a memo, but the decision sort of has been made leading up to that because we have a lot of data and touch points leading up to the next fundraise.
Can you talk about what you consider in those cases, and maybe that leads into whether like a re-up decision or not? I don't know if those are related.
No, we don't have specific case studies, but I can tell you sort of the vectors that are important to us that we focus on. Team is a big part of it. There's huge qualitative signal in that. Like, we do significant offsheet references to get a sense of the manager and the team in terms of their ability to source the best deals, being early with founders, their ability to lead, how they're perceived amongst the syndicate of other investors they work with. Like, that's a continuous process we have. So team, reputation, deal flow, their ability to source, add value. That's the qualitative stuff. That's on the quantitative stuff is you're looking at two things. You're looking at how the fund size is being deployed relative to portfolio construction, and I can get into that, just put a pin on that. And the second part is the actual company performance, underlying company performance at the funds. A lot of folks focus on, well, I did an up round from X, or I have an up round from Y. I think there's some signal to that, but by and large, actual underlying company performance is far more important. And then on the fund size portfolio construction, what we generally look for is, do you have the right fund size and ownership level in an underlying company so that post-dilution at exit, if you have a meaningful outcome, it can return a significant part, if not multiples of your fund.
Yeah.
And the reason that's important is, going back to the very first comment I made in this conversation, is you have dispersion of returns, very few large outcomes. If you happen to have a very large outcome, you really want that to be meaningful to your portfolio. We operate the same way at Accolade. We have a great outcome. We want it to be meaningful to our fund of funds. I'll give you a quick example. Like, take a sort of a $50 million fund, gets 5% ownership. If you're doing well, that's going to be diluted to, I'd say, 50% average dilution in the industry. You sell that company for $1 billion, it returns half of your fund. You need 10 like that to get a 5x gross, high threes net MOIC fund. 10 $1 billion outcomes are hard in a single fund cycle over 2 years. And also, like, you were so early in that company, you worked so hard, like, you want that $1 billion outcome to return multiples to your fund. And so we do generally, by the way, there are a few firms that have defied this model and have done well. You need to have like incredible deal flow and reputation to have many shots on goal and do well. And there are firms that have done that. It's just hard to do that model really well and consistently. On the flip side, you have to have a more concentrated portfolio and invest with conviction. And so what you're doing has to work. I mean, you still can have a 50% loss ratio, but the one or two things that work, like, really have to work, and then you can have a 5 to 10x fund. Mm-hmm. What I literally said for an underlying manager is what we do on the fund of funds level too.
Is there a gap you see in the market? Is there, if you were looking for, is there a strategy, a VC manager or strategy that you feel like you're looking for that you haven't seen yet?
So I'm going to give you an answer you won't like. If we started investing like this, I think we would be terrible. Here's why. Because I don't think we at Accolade are smart enough to figure out what's missing in the market. Let's go find it. But what we have been really good at is seeing everything, finding the best talent that has identified the next thing and investing in them. Mm-hmm. We've had this insight for a long time. We're not smarter than other allocators, or like, we're not going to try to figure out what's next. Now, I can put a pin in that, and I'll talk about why we were early in blockchain and why today we're the biggest allocator. But it's because we saw significant talent go into the space to say this warrants for us to do X. So we have to see the signal from a manager standpoint for us to do something, versus us to say, we want to do something in this part of the market, let's go find the manager. I just don't think we'll be any good at identifying that part of the market. I actually believe the best investors operate in the same way. Like, if you talk to the top venture firms, they will do market mapping, they will think about subsectors, but it's only because they've started to see significant entrepreneurial activity, high quality activity come into that specific sector. The entrepreneur is going to drive where everyone is looking, allocators, venture investors.
Now we're going to take a quick break to speak with our sponsor.
Hi, I'm Jeremy Rich, Senior Vice President on the Catalyst 2045 team at SVB, a division of First Citizens Bank. For over 4 decades, SVB has been the financial partner of choice for the innovation economy. We understand the unique needs of founders, fund managers, and investors building in fast-moving, high-growth sectors because we've been there every step of the way. Through the Catalyst 2045 team, we work closely with venture firms and institutional investors to help them grow their platforms, raise capital more efficiently, and unlock new opportunities across the venture landscape. When you work with SVB, you're not just getting a bank. You're gaining a partner with deep sector knowledge, extensive networks, and tools to help you scale. We're proud to support Swimming with Allocators and the people shaping the future of venture.
And now back to our LP interview.
I think that's a good point to just, like, when I saw and when we first spoke, and you spoke about the investment you all have made into blockchain, it kind of took me by surprise a little bit. Can you talk about just kind of the thinking behind it and what's the strategy?
Yeah, we had venture managers in 2015, 16 who started doing blockchain investing. It was so young back then. I mean, you had just picks and shovels, wallets, infrastructure solutions, and you had the Bitcoin white paper since 2008 that was gaining traction. And then in 2015, Ethereum mainnet launched, which means you finally had a smart contract solution where a theoretical decentralized application can get built on top. We went through the ICO craziness in 17. 2018 was the light bulb moment where dedicated blockchain funds started out of firms you would know, Benchmark, Lightspeed, Sequoia, and Andreessen. We saw significant entrepreneurial talent from all the best universities go and start blockchain companies. You now had infrastructure to build on top like Ethereum. And we said, back then there were 30 blockchain firms or so. And we said, we can't just do one of these 30, we should have a portfolio. Today, we've looked at 560 dedicated venture blockchain funds.
Wow.
So it's really hard to prosecute the space by just having one or two managers. We wanted to have a portfolio. And the reason we did it is because we saw significant entrepreneurial talent, great manager talent come into the space. That informed us we need to have a point of view and a dedicated product around it. That came first versus us saying, blockchain will be big, let's go find the managers. Fast forward to today, I believe we're the biggest allocator. I mean, I don't know globally, maybe there's some we don't know, but 1.3 billion in committed capital. We have backed over 22 blockchain funds, usually the biggest LP, usually at fund one. Same thesis we had in venture, we're doing that on the blockchain side. I think blockchain is earlier in its evolution as an industry, so theoretically, the return profile should be higher than traditional venture. If you're just going to do like a 3x net plus over 10 years, like you can just do traditional venture. You don't have to take the risk on blockchains.
Any advice for LPs trying to thoughtfully navigate investing in blockchain?
If you want access to blockchain, that means you already have venture exposure typically. And I believe if you have venture exposure, blockchain should be a part of that exposure. Just the same way saying AI should be part of that exposure. Obviously, you'll get it through venture, but AI and blockchain are probably the two areas we're seeing the most significant innovation from founder talent. How to navigate it? I think you can, today there are products out there like ETFs where you can access some of the analogy would be like the Magnificent Seven of blockchain, like a Bitcoin, Ethereum. You can do that directly. To complement that with early stage exposure, unless you have a dedicated team to do it yourself, to pick 15 out of 560 fund managers, I would try to find an allocator to help you complement that larger public market beta exposure. I would say the same thing to anyone who's looking to do venture. You can buy some of the public market tech exposure, and then if you don't have the team to do venture yourself, find a fund of funds that could do it for you.
Absolutely. And curious, what are the pieces, maybe it's the things you're hearing from your managers at their AGMs and so on, what are the things in 2025 beyond that are exciting you right now about blockchain? What are some of the, I don't know if it's applications or...
You know, when we started the effort, there were almost no users in the space. Infrastructure was not working in blockchain, meaning like it wasn't scalable, it was slow, the UI, UX was clunky, and regulation was unclear. So when an LP asked us, like, what are the risks? I would say adoption is early, regulation is unclear, infrastructure is early. Like, it's just, you're like in the dial-up phase. Today, for you to do something on the blockchain, like if you want to transfer USD and do something on the blockchain on Ethereum, in 2021, it cost you $10. Today, it costs you less than a penny. There are over 220 million monthly active addresses that are interacting with blockchain applications. And we have a number of companies in our blockchain portfolio exceeding 100 million in ARR in 4 to 5 years on little capital raised. On the regulatory side, in the last 6 months, 5 months of 25, we've had more progress than we had in the last 4 years. If you look at who's at the SEC, CFTC, we have a Bitcoin strategic reserve. We have a stablecoin bill that's close to being passed, followed by a market structure bill. We've had case dismissals against great companies like Coinbase, Uniswap, Kraken, and others. We're actually in a great place with a nice tailwind on the regulatory front. The infrastructure is far more developed, and we have product market fit. And a lot of folks ask about use cases, and there are a bunch of companies that are exceeding 100 million plus in ARR, but the biggest use case today is in stablecoins. Stablecoins last year settled 14 trillion. It's more than any of the traditional incumbent payment providers, with 240 billion in circulation. Now, let me put that in context. There's 1 billion people that are unbanked in the world. Yeah. And the cross-border payment volume globally is 200 trillion. So like we are still so early in actually in that stablecoin adoption. So once we have a stablecoin bill, you're going to continue to see this significant adoption.
Anything from the blockchain experience that you feel that you all will apply to AI Do you think they'll ever be kind of like a dedicated, or is it just so ubiquitous now? That's just going to
It's
be
part of
core
AI. I
feature.
mean, I think there's blockchain is starting to intersect more and more in AI, and it's intersecting in two ways where, AI has the limitations around it needs to continuously consume hardware, GPU, ASIC capacity, and it's provisioning and finding that is hard. Like there's only a few providers that do that. Um, you can have a decentralized solution for that. So Alexa can put her unused GPU capacity on a network, and Ernest can use that to train his AI model. You don't have to go to one of the big companies for that. And we have a
Yeah.
company like that in a portfolio that today is 400,000 containers on its platform across 95 countries, exceeding 140 million in ARR. That's at the intersection of AI and crypto. Similarly, for the AI to get better, you have to continuously train the data and label it. Like that effort can be done through your internal team at a company. It can also be decentralized. And so we have companies like that that are also in that revenue traction phase that are either providing the data or training the data. Anyone can do that on a decentralized network. So I think those are the two areas where you're seeing blockchain really make AI deployment efficient today. And in general, that's what blockchain does. It decentralizes the value creation of a company to everyone, all the participants. And if something is really resource intensive, instead of you raising a lot of capital, spending CapEx to buy that, you can outsource that effort to an independent operator.
What else do you feel that you provide as a value add to anybody who joins your portfolio?
Yeah, so we started quantifying this years ago. I want to put the value add in two buckets. The one bucket is tactical value add. We'll help you with recruiting. Like on the blockchain side, to give you an example, we will refer candidates, we'll help interview candidates, we'll help close candidates for a
Oh, wow.
manager. We help the portfolio companies with customer introductions, partnerships. That's on both blockchain and venture side. We serve as a reference. We have helped with portfolio construction, LP composition, general guidance. On blockchain specifically, we have a whole effort on operational due diligence. This is where it's different from venture. You actually do need help if you want to institutionalize your firm, thinking about what is my valuation policy on a token that's not vested? What's my custody solution? How, should I use stablecoins? If I'm going to stake my assets, how should I stake them securely? What insurance policy should I have? We as a firm have been doing this for 6 years now and have best practice across all of those. So if you're fund one, this is where you come to Accolade. We can anchor you and institutionalize your whole firm for the next future funds.
Wow.
So that's the value add. But I think the second part of the value add, I think this is really important, is we don't just want to be on the LPAC. You're having a bad day and it's 10 p.m., it's midnight, you're calling us. We want to be that LP. We're on Slack channels with our managers. You can call us about anything, whether it's firm related, company related, market related. So we want to be that first call they make when they want to bounce any idea off of their LPs.
Is there anything that you find yourself correcting or educating GPs on that things have changed? I'm curious if there's something you find yourself repeating to GPs that are pitching you or the GPs in your portfolio, where because you're sitting one level above, you see things differently.
Yeah, and this isn't necessarily related to our existing managers. I think broadly, managers in venture and blockchain forget how hard it is to consistently outperform. Like the venture asset class is really hard. I mentioned there are 3,000 to 4,000 firms in the U.S. Only a couple of dozen have consistent 3x net returns. That's a really, really terrible ratio for an asset class. And so, like that, I mean, that's why fund of funds I think exists, because they're going to pitch, we're going to get access to that 2 dozen firms. But I think managers forget how hard it can be. And what I mean by that is, it is really important to stay disciplined in your approach. If you have an ability in a lane that you think I can do X because I have the competitive advantage in deal flow sourcing in this part of the market with this fund size, and I have a way to own X amount with these historical exits to get a 3 to 5x net fund, it's really important to stay in that lane, fund after fund after fund. Despite the fact that you're going to have a lot of LP interest, despite the fact that you can raise a lot more money, have multiple funds, etc. I think that's the one thing we remind our LPs is, not just our GPs, but GPs generally, is do you want to be the best or do you just want to grow? And I think, I mean, there are two paths to doing that. And by the way, there is a narrow path for you to grow and continue to be the best, but it has to make sense bottoms up. That's probably the number one thing that comes up.
Does that influence how you change your touch points and how you advise firms as they scale? Like comparing like when you first work with someone at Fund One, obviously you can help them institutionalize. You use the example with blockchain fund managers, but as they do scale, how does your coaching approach change, if at all?
Yeah, I don't want to use the word coach. Like we're never going to coach our managers. Our managers are 100% of the time in the driver's seat. We're sort of very
Yeah.
much in the back, and if they need us, we'll help them. Like, and we'll give them guidance. But I think what we really focus on is always be bottoms up focused. Whatever you do, is think about where your strengths and weaknesses are as a manager, where you can excel. That means opportunity set, fund size, check size, account for dilution, follow-ons, etc. That's your fund size. Your fund size is your strategy. And so staying consistent to where you have been excellent at delivering, both in terms of deal flow, actual sizing of investments, like that's what we remind our managers to do well.
And in your own planning for your next fund, are there any adjustments you're making? I am sure you were very disciplined, but I'm wondering if there's any lessons learned or, if you're leaning into X more than Y on the next fund.
Kept the fund size the same, deliberate approach. The fundraise was the quickest we've ever had as a firm. I mean, didn't require cold calling this time or cold emailing. No, I mean, look, everyone makes mistakes. I think we learn from our mistakes. I think we want to keep the strategy, the portfolio construction, and our filter pretty consistent. Has our process become more rigorous over time? Absolutely. We have the same team, but we have more process around it. But I actually think if you look at the next 2 to 3 years and you look at the funds we just raised, it will look very similar. On the blockchain side, I do think we're leaning in a little more into secondaries and more interesting creative structures, like GP stakes as an example. So we would love to do more of that. That's more recent, I think, on the blockchain side. And secondaries on the blockchain side, like you could see upside significantly higher than a primary fund investment.
What's your views on secondaries for your core venture portfolio?
We look at them. It's really hard to find, and most of the secondaries we've done in the past have been in our managers. Mm-hmm. It's one, they don't trade often. Two is they're so high quality, their discounts are low. It's very hard for us to underwrite to what we're looking for. On the blockchain side, because it's blockchain, it's an early industry and people don't understand it as well, you could actually get 50+% discount on a high quality portfolio. Mm-hmm. And because we've been doing it for a long time, we're the largest allocator, we know these portfolios really well. I just think that asymmetry is less prevalent on traditional venture in secondaries.
Is there a favorite point? I can tee this up if there's one, final thought, something that you just love teaching people, or, anything that we haven't gotten to that you love to pound the table on?
No, I think you covered it all. I get asked a lot by managers about managing liquidity as well, especially in a market today where we see very little liquidity in venture. We're in a weird environment where you've had hundreds of these unicorns that have been created over the past few years. The majority are kind of stuck. They either have to raise a down round and they haven't met their projections. And then there's this small subset that has continued to raise at even higher clips very, very frequently because these are the best companies and all the private capital is chasing them. On top of that, these management teams can do tender offers, which relieves the pressure to go public. And so the best are staying private longer simply because they can. And the venture investors are allowing that because they're putting more money to work in them. And by the way, these are really high quality companies. They're not rule of 30, 40. So you look at the public markets, rule of 40 trades at 8 times. These are rule of 50 to 100 plus. In the public markets, those companies get 15, 20 times next 12 months revenue multiples. And so managers always ask about liquidity. And I think if you're a large manager that, one of the big brands, it's hard to get liquidity in these companies because you have your own multiple funds that are all invested in this company, you have to wait for an IPO or a large M&A event. Maybe there is some way for you to do a large secondary, like a continuation vehicle, but that's generally, we don't see a lot of that. If you're a smaller pre-seed seed manager, though, there are ways for you to take money off the table along the way before the company exits. So we do see a lot of managers take advantage of the later stage venture market if you are a really early investor. And if you are returning 3 times your fund and someone wants to come in and do a round, maybe you take some money off the table.
Yeah.
You don't have to take all of it off the table. Like, there's a balance between your level of conviction, where you are in your fund cycle. Do you really think this company can 3 to 5x from there? Take all that into account and decide what ratio makes sense for you to sell. But we do see that, and like we talk to our managers quite a lot about like balancing of what's the right thing to do. We don't get involved in saying like, you know this company best, you have the conviction in it, but decide what's best to do in terms of liquidity given where you are in your fund cycle, how much of your funded returns today, what's your level of conviction going forward.
Yeah. My first associate VC role, I got to sit in on the conversation about, okay, Zoom is going public and we have the opportunity to sell some before the IPO. How much do you take off the table? And, you're sort of...
What'd you do?
You're like not breathing, holding your asshole tight, being like, I hope this is the right call. They did take some off the table at Maven, and it was exactly the reason you were describing, was that it was returning the fund. It was everything above that was going to be gravy. So it was a pretty easy call.
Yeah, makes sense.
Well, this has been an awesome conversation, sir. Thanks so much for spending time with us. And how can people find you all?
I'm just Aram at AccoladePartners.com, and anyone can ping me on LinkedIn. I think maybe the email is on the website. So I have a 0 inbox policy, so if you email me, I will make sure to get back to you within the 24-hour window.
Holy cow.
I can't confirm that. or you might just get a cold email from him. So, but thanks again, sir.
I appreciate cold emails. I've always responded to every cold email because I did it myself and will still do it.
Well, thanks so much.
Thank you for your time.
insights.
This was great. Yeah, a really great conversation. Thank you.
Thanks.
See you later, allocator.
After Portfolio Tile, investing with a smile.